Today, we are going to look at MassMutual's 10-pay policy. Specifically, we'll look at different funding periods. We'll see what the 10-pay policy looks like if an individual who's starting at age 50 funds for 10 years, hence it's a 10-pay product, so they fund it as long as they can. But then what it looks like if they fund it for 5 years, and then what if life happens and they stop payments altogether after 2 years? We'll look at that option as well. All the same product, we're demonstrating different what-if scenarios. Answering this question, what do you need to decide up front? The answer is just how much you want to start with on day one. What we'll look at is maximizing the cash value growth. This individual wants to get the most out of his money. He wants to maximize the internal rate of return, which is nice if you're looking at things from a rate perspective. And then also a dollar perspective, the same thing would be just looking at maximizing the cash value growth. So let's take a look. And what I'll start with is this guy, the MassMutual 10-pay policy among MassMutual products. So if you're comparing different products, all with the same company, so it's a fair apples to apples comparison, what you will find is that the 10-pay policy will generate the highest internal rate of return, meaning you'll get the most out of your money. Now, what's the drawback to a 10-pay policy? Potentially paying into it for only 10 years. What if you want to fund it for 30 years? Would I go with a 10-pay policy? Not if I want to continue to fund that same policy. Some people like the idea of taking out a 10-pay policy, and if they want to keep going, they'll take out another one, or maybe it's a different product with a different company. But some people like that idea, or the idea of doing that where, hey, let me just focus on this one right now because I know I'm going to maximize the cash value performance. And if I really want to after that, then I'll get another policy. And maybe I'll get a different company or product. Now, of course, there's some risks with that. If anything happens to my health, I might not be able to get another policy. I've got to go through the early years and the expenses again. So we want to make sure that that's discussed up front. But sometimes people will approach that. And the main reason why is because it's an attractive policy. So let's take a look, shall we? Beginning with the straightforward option, 10-pay for 10 years. That's how long I can pay into it. Annual outlay, $100K per year for 10 years, nothing thereafter. Where's the money going? So of that $100K per year, here's your premium, $10,000. Then we've got different riders. So LISR, that's life insurance supplement rider. The $381 and change is a term insurance death benefit, which the premium does not cost $3,400. The premium of $3,400 and change is a combination of the cost of the term and then also money going into PUAs. Then we've got scheduled AILR, which represents additional life insurance rider. This is MassMutual's pure PUA rider. And then we've got renewable term, $580,000 for almost $1,600, which is a term insurance rider. A lot of term attached to this policy. Here's why. What we're aiming for here is a cash-rich policy with a low premium. So of this $100,000 per year, what is committed to is the premium and the term rider cost, the renewable term specifically. So if we round up, call it $12,000 or $13,000. So that's the minimum commitment. He wants to be able to commit to a low amount and then add up to $100K per year. Even though he feels he can do $100K per year, he likes having that low premium. It also gives him a lot more cash value up front in addition to having it long term. So that's fantastic. He's attracted to that. Now, when we look at this guy, back to the reason behind all of the term insurance, that premium, $10,000, buys him a death benefit of $127,000. That'll give him a MEC limit. It's between $11,000 and $12,000. The thing about a 10-pay policy is when you look at it with just base premium, you're funding almost up to the MEC limit. So there's no room to add additional PUAs naturally. The only way you can usually add PUAs to a 10-pay policy is if you add a term insurance, which can be very attractive because a 10-pay policy performs at a high level. So when I start juicing it with term riders and PUAs, it's going to make things look even better. So what we did was add term insurance to raise the death benefit, which raises the MEC limit. This way we've got a permission slip to be able to fund up to $100K per year while keeping the premium low and such. So this is how we're maximizing the cash value. If you look at the break-even point, you're between years 4 and 5. You're close at year 4. You've paid $100K per year for 4 years. Cash value is $396, almost $397. By year 5, you're positive. Look at your death benefit too here. With the amount of PUAs, particularly toward ALR here, that death benefit's appreciating at a fast rate. While the 10-pay product is designed for strong cash accumulation, generally what you will see, this will always be on the non-guaranteed side of an illustration, is that the product with the most cash value long-term will often have the highest death benefit long-term as well. And why would that be? If you've ever looked at an illustration, what happens with most illustrations at age 100 when you look at the death benefit and cash value side by side? Are they the same or different? They're usually the same. Some products that occurs at age 121, but a lot it's age 100. So if I've got a product with the most cash value by age 100, the death benefit will be the same. Usually you'll see a high cash value product have the most death benefit long term. When I'm getting in my 80s, that's usually when you'll see it overtake other products that start with a much higher death benefit. But back to this, we're funding it for 10 years. Look at year 5 with me. 510,906. Have that number in mind? 510,906. Year 5, what's your cash value? 510,906. What's the difference with this illustration? All of this is the same. That's the same, the first 5 years is. What your funding is until year 6, you pay nothing in. So we stopped the funding in this example after 5 years. So instead of getting a total of $1 million in, he's paid a total of $500,000 in. Now let's look at the fun one, which often results in someone saying, I didn't know you could do that. And then we want to fund a policy aggressively for a short period of time. Sometimes we see that, which you can do, but in a case like this, I would actually fund it for 3 or 4 years minimum. You can get away with 2, and it looks good, but you can make it look a little bit better if we were just working with a lump sum. If I wanted to get a total of $200K in, I might do it in 4 payments of $50K or 3 payments of $60,000 and change. So, $200K over 2 years, 0 thereafter. Look at this. Cash value continues to appreciate, which is exactly what we want here. Very good. Premium is still due through the 10th year. We could get rid of it with a reduced paid up option, but we kept it in this example. So he's got the option to resume payments if he wants to, but it continues to appreciate here. So this is a nice option because we can see we can fund it for 10 years. That's what I plan on doing up until the age of 60. If life happens and I cannot, what does it look like? Show me 5 years. What if it really goes south and I stop after 2 payments? Even though I've got the cash on hand right now, we might hear something like that from an individual, but looks pretty good. Can do the same thing here, or look at the same thing with everything side by side. 10 years, 5 years, 2 years. Can look at the internal rates of return. Annual isolates the yearly growth rate. Average is the average IRR. It's going to factor in the averages. Why it's lower is because I've got to make up for that first year. And then the same thing, but with dollars. What I did for simplicity is just look at the total gain on cash value. Nice policy option though. Good option if someone knows they want to pay into a policy for 10 years or less. Let us know if you have any follow-up questions on this product or any products or have any comments in general. Thank you so much for watching. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.